Welcome to this installment of Underwriting Monthly Education Series. My name is Mike Whitbeck, the co-founder of Blueprint. And today we're going to be talking about rental income and how fair rental days affect your borrower's income. Now, there's a lot of confusion on this topic, and that's why we created this training. I had this question come in a few weeks ago. I figured it's about time we put some information on the web about it because it's not a very well described subject amongst the underwriting guidelines or the underwriting or processing community. So first of all, we have to explain what fair rental days are so we can understand how they affect underwriting and how does fair rental days affect our rental calculations, because that's what we're focusing on right now is income analysis. And as we know here in 2023, about June right now, that the business is a bit slow and the agencies are being very harsh on their underwriting evaluation auditing, especially since the market's a bit soft. So they've got lots of time to research your files you've turned in the last couple of years and look for errors. And there's a lot of buybacks or basically write-ups or audits coming back, which are going to hurt the business even more, especially when it's slow and your profits are low. And then you got to start paying back old commissions we earned a few years ago. All right, before we get in this topic, quick commercial. Hey, just gonna let you know, if you need a tool that takes the guesswork out of income calculation, at Blueprint, we built what's called Income Expert and Income Expert Plus. Come check it out, come to our website, but this is a systematic way to calculate any borrower's income, no questions asked, right? We have the rules for all the agencies, we got the calculations, we had advisories, and just millions of files, literally a couple million files we've run through the last few years. We have over almost 200 banks that use us. Some of our clients do 1 or 2 loans a month. Some do 6 or 8,000 loans a month. So we can handle big and small. Check us out and get us more information at getblueprint.io or send us an email at info@getblueprint.io. All right, so that's enough for my commercial break. Let's get into it. So we talked about fair rental days. So let's see where you'd see these fair rental days. So you're processing or underwriting a file, or basically originating a file, and you're trying to work up the borrower's debt to income ratio. And you notice they happen to have 1 or more investment properties. So when you're looking at tax return, you see they have a Schedule E. And when you're looking at the Schedule E, to say this person has a property on listed as A, 123 Reynolds Street, but you notice they have fair rental days. Now, the mistake that's made is a lot of people think fair rental days is the number of days you've owned the property that year. That's not correct in almost all cases. There is a few cases where the CPA will use it that way. For example, if I bought the property in June of 2022, and this is my 22 return, because the CPA knows there's no way you can rent it out prior to owning it, they will put fair rental days down. But I'm going to warn you, that is not the primary way that you decide when somebody purchased a property to work on your math calculations that we're about to go over. This could be 180 fair rental days because they only rent it out part-time. They use it personally half the year, or it was under renovation, or it's a Airbnb type property. There's a lot of reasons the IRS uses fair rental days. So you can't make the assumption that, oh, they've only owned it. I get that question quite often. They're like, hey, why wouldn't you divide this by 6 or 8 months instead of 12 because the fair rental days are lower? And that's what we're explaining here in this training. So fair rental days are not the number of days property owned in most cases. I get there's a few cases there would be. The fair rental days are used for the following reason with the IRS: to calculate income and deduction for taxing purposes. They have to know how many days the unit was actually rented or being worked on for rental or being listed for rental versus your personal use of the property, or that you choose not to rent it. Basically, the IRS is not going to, I guess the example would be if you had a car, a company car that you were writing off on your business. The IRS does not allow you to drive it around personally 20,000 miles a year and then drive around for business 5,000 miles and write the whole thing off. Now, lots of people do it, doesn't mean it's right. Okay, so that's what fair rental days do. They try to take the actual expenses and give you deductions only for when it's being used for business purposes. All right, and there's a lot of things you can read on it. If you Google the IRS instructions, feel free. But for underwriting purposes, we don't need to go much deeper than that. So fair rental days from a calculation purposes. Now, this is what the IRS is doing. So I want to show you from the IRS standpoint, and then we'll talk about it from the underwriting standpoint. So if I tell the IRS, and I give them my Schedule E, and I count my fair rental days as 180, so about a half a year. I've had the property, it's just like it's an Airbnb, or I keep it personally for the summer, it just doesn't rent or whatever. If they audit me, I'm going to bring them a receipt for a $1,200 home insurance policy, My fair rental day says 180. The IRS is automatically going to go take 180, divide it in 365, and find that's 49% of the time that that property was used for business. So now I take my $1,200 rental or my policy, my insurance policy, times 49%, and I can only deduct $588 on my Schedule E. So it is adjusting your actual costs to the business costs. And that's why some owners get tripped up again thinking that, oh, this is just the number of times they own the property. It's not what it's for. If you read the IRS instructions, it will walk you through exactly what to show you and talk about this deduction and personal if it's under renovation, things that we don't need to know in underwriting, but you need to be aware of it. Now, calculating with fair rental days, always assume that a rental property has been in service or in ownership for 12 months, right? The only way that you should take it off if you see the fair rental days or the borrower describes it or your like data verify or in the file the loan officer gave you a title transfer or closing or whatever proving that the property was not owned for all 12 months, then you're fine. Or perhaps you have that out of service exception, which is another talk altogether. But there is specific rules when the property is owned but out of service you have to watch for so you can reduce your denominator. But the bottom line is what we're saying is that the fair rental days is not about ownership in most circumstances. So if you put this up on a kind of a chart, it would look like this. Hey, we got this property 12 months of the year, and I'm here in Michigan. Let's say it's a ski area, so it gets really busy in the winter. November, December, January, February, March, it kind of thaws out. Nobody uses it in the spring because it's all muddy up there. But it also rented out a few days during the month for outdoor activities, and then maybe like Oktoberfest, and then there we go back to the next season. So this is what it looks like as far as rental days go. Now you can imagine if you're charging rent by the night or by the week or whatever, is there a time here where you're not making any money? Yeah, April, May, you're making nothing. Only making a few bucks here in October. So if I switch this chart from days rented to cash, okay, so let's say at $133 a night on average, I bring a lot of money in my January, December, November, February timeframe, but I don't really make any money in April, May, September, and a little bit in October. So now let's look at our Schedule E. So when you're looking at the Schedule E and you see 1, 2, 3, 4 rental property and it has 180 days rental, a lot of people again will divide this by 6, which they shouldn't. What if you add up this little money chart here across the board, it would equal 21,280. Now remember, that's income for the entire year, not for 6 months, 1 year. And then these expenses are what you could write off based on 180 days. So the HOI policy is actually like probably $2,000 a year, not 1,000, because they're only allowed to write off about half of what everything these expenses are, half the taxes, half the supplies. Now there's rules like you can write off all supplies if you prove it's all for rental. So I'm not digging down to a CPA level course, but it doesn't really matter. Whatever the CPA puts there, we're going to go with. But when we do the math, it's like standard rental math. I take the 9180 from line 22 or 21, I'm sorry, and then I add back my depreciation, line 18, my taxes, line 16, my mortgage interest, line 12, and my HOI, line 9. That's 20,180 on both examples. Now on the left is the right way to do it. Divide it by 12, that's 1681 per month in gross revenue, okay? Minus your current PITI of 1,500 equals 181 in net rental per month. But if I do it wrong, look at the difference. I divide that by 6, I've got 3,363 in gross revenue with 1,500 PITI, 1,863 net rental. Now, you can imagine that adding an extra $1,500 a month to your borrower's income is going to create some buyback issues, okay? So let's visualize this. Do you really think that 1863 is the average with the empty months and the full months? Does that look right when I put this on a chart? No. I mean, how are we getting all expenses, which is orange, and no revenue, but bringing in 1863? Well, Mike, we're averaging it. But again, do the math. We're averaging it wrong. So does it look like this, or does it really look like this? Well, this is the right answer, okay? So fair rental days. You have to know what they're for the IRS purposes and how they apply. And again, I just don't want to see, and the purpose of all these trainings is to make sure that your income analysis is done properly by the books, that you understand the what, why, and how of doing some income analysis using underwriting methods. Hopefully this has been helpful. Again, thanks for watching. Again, Mike Whitbeck, co-founder of Blueprint. If you got any questions, hit us up at our website or come check out our demo. Email us at info@getblueprint.io. I look forward to talking to you on future trainings. Have a great day.